In this video, we're going to start our discussion of behavioral finance. We're starting off with belief perseverance biases, which is a type of a category of cognitive errors, and I'll map things out in just a moment. So, biases in general, what you need to learn in the behavioral finance section of portfolio management at level 1. Well, biases are certain deviations from the rational way of behavior, and we as humans exhibit from time to time, some of us more frequently, some of us less frequently, irrational behavior or irrational courses of action. And those, at least in finance, are typically linked to certain biases, certain preferences, judgments, which skew us away from what is considered to be rational. So these are going to be behavioral biases, and they are generally grouped into two categories, which we'll be exploring in this video and subsequent videos. The first of these is cognitive errors. And in this video, I'm going to specifically focus on one type of cognitive error. And the second is what's known as emotional biases. Okay. So this is the very sort of top level differentiation or split. Cognitive errors. This is all about faulty, so containing some kind of mistake, faulty cognitive reasoning. So the way we learn, interpret, internalize information is in some way faulty. And this is very different to emotional biases, which are not the result of faulty reasoning. They are the result of overlaying the reasoning with emotions or feelings. So this is going to be faulty cognitive reasoning. This is going to be mistakes or deviations from rationality, which are the result of emotions, feelings coming into play. Now, I know it's difficult sometimes to separate the two, but for the purposes of the exam, you have to understand this difference, and also the fact that cognitive errors can be remedied or they can be corrected, typically via things like education. So learning better information, exposing yourself to more than one source of info, for example. Also advice as provided by a financial advisor, one that can recognize this type of behavioral bias when they see it. On the other hand, emotional biases, because they're linked to feelings, emotions, so something much more impulsive, they are going to be harder to correct. Not impossible, but harder to correct, because you are here fighting with sort of against human nature. They come from the intuitive side of our behaviors, the feelings, so definitely harder to correct. Now, we're going to leave emotional biases until the third lesson in this series, or the third video. We're going to focus on cognitive errors first. And let me say that these cognitive errors, they come in two categories. We're going to explore one in this video and the other in the next video. So the first one is belief perseverance biases. Perseverance biases, the topic of this video. And the second one is called processing errors. I'm going to handle this one in video number 2, and video number 3 is going to be about emotional biases. Now, what's this one? This is the tendency that we all, to some extent, I guess, exhibit, to hold on to prior beliefs that we already have, to previously held beliefs. In other words, those beliefs persevere, they stick. Of course, we constantly are bombarded with fresh information, fresh data, including financial data, and that information may be in contrast or may be contrary to our previously held beliefs, but often we choose to, in some way, ignore it, pretend it's not there, and this is what this lesson is going to be about, those actions that we take which are irrational because we have this belief perseverance bias or a set of biases ingrained in our behavior. So new information that is contrary obviously to previous beliefs, the beliefs we already hold, causes something which the curriculum describes as cognitive dissonance. And it's a good idea to remember this phrase, cognitive dissonance, which is a bit like mental discomfort, basically. The mental discomfort of having to adjust your previously held beliefs, which are ingrained already, which you feel comfortable with, and having to update those, which also means you have to kind of internally admit to having a belief which is no longer valid, right? So this is something called cognitive dissonance. It's actually mentally painful to go through that process, which is why we sometimes don't want to do it as individuals. When it comes to processing errors, okay, it's not about the tendency to hold on to previously held beliefs. This is simply illogical, irrational use of information. It's not about blocking that information, not admitting to it. It's just interpreting it wrongly. But as I said, that's going to be covered in video number 2. Okay, so what we're going to do now is basically list the biases which your book identifies as the main, the prime belief perseverance biases, and provide a definition for each one, and also what it actually causes in the world of investing, and how to potentially spot it, and more importantly, how to correct it. Because with these belief perseverance biases, it will be, in most cases, possible to provide some corrective measures. Now, from the point of view of the exam, obviously, this is a very theoretical topic. You're not going to get asked any numerical questions on this. It's impossible. Well, it would be possible, but you're essentially not going to get numerical questions. It will be all theoretical. And it's important to be able to identify the bias exhibited by somebody as presented in a description. But also, please, when you are learning this stuff, try to remember which bias belongs to which category. Is it a belief perseverance bias, or is it a processing error, or is it emotional, right? Those distinctions can also be tested. Right, so let's start with conservatism bias. Which is, I think, a pretty simple one. This is all about maintaining, so keeping prior beliefs, sticking to prior beliefs, views, forecasts, estimates, you name it, despite new information, which obviously that new information may go counter to what you currently hold. So it's all about, I guess, inadequately incorporating new information. Okay, and well, what's the consequence of this? Pretty easy, I guess. The consequence is going to be that you don't update, not updating your forecasts, your beliefs, your estimates, beliefs about maybe a company and its prospects, despite the new info. Info, obviously short for information, and let's think about some corrective measures, at least the measures that your book, your curriculum identifies here. Well, the first one is kind of obvious and primitive. Well, as a corrective measure, they say, make sure to properly analyze all new information, properly analyze new information, which is, I guess, obvious, because the whole problem is that you don't properly incorporate the new info. So, spend time to analyze that new info. And, they say this is all about cognitive dissonance, the name we mentioned before, the fact that this new info, new data, which may run contrary to what you already believed, may cause you that mental pain, that cognitive dissonance, which we talked about. And it's especially, that cognitive cost, the cost of incorporating the new info is going to be especially high when the new information is of a technical nature, maybe statistical or abstract. So it may be difficult to process and therefore actually easy to ignore and say, no, that's not relevant. Another corrective measure is sort of deliberately, so intentionally asking yourself how the new information ought to impact on your previous beliefs. So how the new information changes our forecasts, estimates. So actually challenging yourself to think about this. And of course, if that new info, as we said, has a big cost in terms of interpreting it because it's complex, always don't be afraid to seek guidance. If the new info is, I don't know, complex, difficult to understand, pretty obvious things, right? Conservatism bias. Now, the next one is quite straightforward, and I'm sure a lot of us will identify it as something that we are ourselves guilty of. When I say guilty, I mean, don't think about this in a real guilt sense. This is part of human behavior. These are behavioral biases, and it's a question of knowing that we do this and correcting our, actions accordingly. So the next one is going to be something called confirmation bias. Confirmation bias, that's the name. And this is, you see here, you get new information, but you don't incorporate it properly. With confirmation bias, it's all about intentionally looking for information that will confirm your previously held beliefs. For info which confirms existing beliefs, views, and at the same time blocking, ignoring info which contradicts those beliefs stroke views. Okay, so it's very, very much linked. All of these are linked. But here, in the first case, we were receiving the information, but then choosing to, let's say, not update our forecast despite the new info. Here, you are actively, intentionally seeking information that is going to confirm what you already believe in. Now, your book suggests some examples of this. So as a consequence, what I could write here, this is based on a curriculum example. Holding on to a stock investment despite new information suggesting it is no longer attractive. And in the book, what they kind of this on its own is not the full story, because in the book they say, as a basis for this decision, to hold on, what the asset manager does, so the fund manager, and this is the confirmation idea, is he or she talks to an analyst who has a positive view of that stock, but despite new information which seems to contradict that this positive view is valid, they completely fail to talk to the other side of the equation, fails to speak to an analyst, with a negative outlook on the stock, despite getting some info which may suggest that this is also potentially a valid viewpoint, right? So this is the element of actively, intentionally seeking confirmation that your current beliefs are okay and ignoring the information that may contradict it, or arguments which may contradict. So considering only the positive info, ignoring negative. Another one is, but this is more to do with how we pick stocks. So sometimes analysts and asset managers develop specific screening criteria against which they use as a basis to decide which stocks are good, which investments are good, which investments are not so good. And once you develop such screening criteria, it's very comfortable to put them in place, implement them. But are you updating those screening criteria? Are you checking whether those screening criteria are still applicable in what is, after all, a changing world? So developing screening criteria and subsequently failing to update them, adapt them, recalibrate those screening criteria. Okay, now as a result of all this, what may happen is we may, and this is a big consequence and big negative sort of consequence of this, is that we may end up holding under diversified portfolios of investments, holding too much of concentration in a single company or a single sector, which our screening criteria seems to suggest as being the one. And also, it's potentially quite difficult to seek what could be negative information about your own employer, the company you work for. And in many countries, such as the United States, employees of companies often receive compensation in the form of their own company's stock, shares, or options on such shares. So, what may happen is if employees are encouraged to invest in a company's stock and they don't, rationally and objectively view positive and negative data as confirmation bias may suggest, you may end up with an overinvestment, which is once again linked to the concept of under diversification in the shares of your own employer, the company employing you. Why? Because once again, it would be quite difficult. There would be a big cognitive cost associated with acknowledging that there may be something wrong with your employer, the company whose shares not only do you hold, but actually you work for it. So your future is very much tied to it. Now, once again, let's think about some corrective actions over here. Well, they say, if this is the problem, then try to push yourself and actively seek. So actively seeking out information which challenges currently held beliefs, currently held beliefs. I think this is much easier said than done, to do this yourself and challenge yourself in this way. And if you're making decisions based on some previously held belief, like a screening criteria, if information is based on a previous belief, or some kind of screen, some kind of test, like I tend to invest in companies whose certain financial ratio is above a certain level or below a certain level, and that's my screen, that's my way of selecting, then why not corroborate this, meaning check this against, corroborate, validate this, check this against, confront this with another perspective or another sort of viewpoint, another source. Once again, easy to write down, not difficult to do, to challenge yourself mentally to do so. Okay, the next belief perseverance bias to consider is something called representativeness. Representativeness, that's a long word, right? Representativeness bias. Yeah, I wrote that correctly, hopefully. And it's actually split into two biases, which I'll write out in just a moment. But let me first put down a definition. This is our tendency to classify new information based on previous beliefs. Based on previous beliefs or classifications. And I guess, and this is where the name comes in, this boils down to treating new data, new info, as something that kind of automatically has to fit into a slot in our heads that we already have, a classification that we already made in the past. Treating new info as representative of past beliefs. Good. This may be split, and your book does this, right? This representativeness balance gets split into two biases. And once again, it's good to know the names. One is base rate neglect. And right, let me write this down and try to explain what it is. It's not so easy. This is all about treating the rate of incidence, meaning the rate at which something appears, happens in a larger population. Let's call this the base rate. As irrelevant. And this rate of incidence in larger population base rate is ignored in favor of specific information. And I'll try to illustrate this with an example in just a moment in specific information. Okay. So the example which your book gives for this is quite interesting. It says, imagine, you open a newspaper or some source of information on the internet, and you find out that a specific company is in trouble, a company from a specific sector, a specific industry, a specific location, and it's gotten into some financial trouble. And that would be an example of specific information concerning that specific company, that specific stock. On the basis of that, you could obviously, assume a short position, exit your investments, etc., treat the company as something bad. However, maybe you would be guilty of ignoring the base rate. The base rate in this case being the information that you have more generally on that specific sector or industry, because it may be also the case that companies who operate in this sector, even if they get into trouble, more likely than not, as history may suggest, they get out of it. So companies typically, maybe in that sector, even if they get into some difficulties, they are able to overcome them and still, profit and prosper later on down the road. So the case is, what's more likely? The fact that this specific company will go down, will get into, will endure financial difficulties, or is it more likely, and this is going to be based on the more generic information about the industry or sector or geography, that companies from that sector generally pull through quite well and manage to deal with problems very quickly? And your book says, look, it's more probable that the base rate is going to prevail rather than the specific information. However, we often get very attached to that specific information and make our judgments based on it. So specific information may be misleading as compared to data or information concerning the wider population, and that's what we consider to be the base rate. Now, the other type of representative bias which you may come across, other than base rate neglect, is sample size neglect. And this is where we take a small sample and treating it as representative of the wider population, which is obviously a mistake. Just because one company in a given sector is in trouble doesn't mean the whole sector is in trouble, and the other way around. Now, what about the consequences of this bias? Well, the consequences for portfolio management or for investing are such that we often build or create forecasts, stroke beliefs, estimates, and so on, based on either this individual specific information, ignoring the wider picture, the base rate, But also, we have a tendency to build our beliefs based on small samples. Which is also a mistake. And your book says, well, also have a tendency to update forecasts that we already have on based on simple classifications that we already hold. Now, once again, how do you overcome this? How do you correct it? Asking questions, obviously asking yourself questions, which is a difficult thing, questioning yourself on probability. Like, with base rate neglect, which is the favorite example in your book, in your curriculum, what's more probable that this specific company will be, its performance will suffer, or is it more probable that because it belongs to a sector which generally is doing well, it will pull through anyway? And more often than not, the answer you should give is going to be going with whatever the base rate suggests rather than specific information. So if in the exam you're presented with such a choice, what's more probable? Go with whatever the base rate is suggesting. Okay, let's discuss the final two biases under belief perseverance biases. The first one of these is going to be something called illusion of control bias. And this one is going to be the belief that one can, or we can, that the investor can, that one can effectively influence or control certain outcomes when that is not the case. So obviously sometimes we can control the outcome when this is not true. And this is, perceiving oneself as falsely having some kind of controlling power or the ability to influence how things will go. So the examples your book gives, one is a completely non-financial one. For example, picking your own lottery numbers is one example of illusion of control, that you can do this better than some kind of random pick done by a machine. And the second, more of a financial one, is when employees hold shares of their employers, something that we already mentioned before. But this time, ignoring bad news because they think they can make the company, perform better via their own work, and stating stuff like, we're going to pull through as a company because we're going to work hard. Well, even if you as an individual employee work hard, it doesn't necessarily mean that the company as such will perform well, because your ability to influence what happens at the business may be very small, unless you're a top executive and you have some insider information. So, this is often something that people do when they possess stocks of their own, the company that they work for. Now, what are the consequences? As is often the case with these, it's going to be under diversification. So holding portfolios which are not diversified enough, because people have a tendency to hold on to stocks, investments which they think they have an influence over, such as the just mentioned investments into shares of the companies that they work for. Another one is, when you're feeling you've got control, you very often develop a tendency to trade excessively. So excessive trading or over trading And this leads to higher costs, which obviously makes your portfolio performance suffer. And right, also, this is an interesting one, not an obvious one. Developing models, obviously financial models or forecasts, which are too detailed. Why? Because we sometimes think that if we develop a very complicated Excel spreadsheet model, with lots of parameters and variables and inputs, we're in some way going to control the future. Well, that gives us the ability, the illusion, the illusion is that we can therefore master the unknown future. Well, that's not the case. And sometimes these models are too excessive given the complexity of what the future may bring and how difficult it is to project the value of the inputs that go into these models. So, what are some of the remedial actions or corrective actions? Well, your book says, why don't you just start with realizing that you are not in control? Sounds like a self-help book, not in control. Okay. There are many factors at play in financial markets, and you are not in control pretty much of any of them. So the sooner you realize that, the better. But also thinking about downside risk. So when you think you've got the ability to influence something, obviously I'm assuming in a positive way, well, think about the downside, and what can go wrong. And if it's difficult for you to imagine what can go wrong, then, seek out somebody who has an opposing view to yours and speak to them about their arguments, and maybe that will convince you or at least make you think about it. Right, one more here to discuss under belief perseverance biases, and this is an important one. It appears a lot as an answer to potential questions in your curriculum. This is going to be hindsight bias. And it's something that, once again, most of us are in some way or another guilty of exhibiting. This is the belief that past events could have been predicted, were predictable, or reasonable to expect. It was reasonable to expect them. Now, at a more personal level, the way this plays out in the case of many analysts and their behavior is remembering. Let me write that again. Remembering, your past predictions as accurate, as good ones. Obviously, if those traits based on those predictions were confirmed, were successful, if they are proved correct, if they are confirmed. But at the same time, overstating poorly reasoned decisions with positive outcomes, poorly reasoned decisions with positive outcomes. So I'll give you an example of this, a personal one. Now, the first one, remembering past predictions as accurate if they are confirmed. You're always going to be more inclined to remember your successes, your predictions, even if they didn't lead to a complete success. Oh, I knew it was going to happen and I was right. Oh, maybe I didn't take the requisite actions in terms of investing money, but I was right. I remember I was correct. You're going to remember those things rather than more than those instances where your predictions were not correct. Now, overstating poorly reasoned decisions with positive outcomes. This is an interesting one. Sometimes you make a decision to make an investment on the grounds of a certain prediction, and it's not just a prediction, oh, it will go up. You think, you go through a process where you believe that because of something happening, I don't know, the value of the dollar against the euro will go up. Maybe it's to do with interest rates, right? Or decisions which heavily influence exchange rates. And it may end up that indeed, the dollar against the euro does go up, but for a completely different reason, maybe to do with the geopolitical situation, which is also a fundamental factor in the euro-dollar exchange rate. I mean, I remember one such case where I had built up an argument for currencies or exchange rates going in a certain direction, placing money on that, investing money into that trade, and then being very successful in it, but for the wrong reason. It turned out that something else happened to cause the currency markets to go in that direction. And I was very proud of my decision, and I kind of ignored the fact that it was poorly argumented. I just focused on predicting the correct direction of movements, even though the argument was wrong. And often people say, with hindsight, they state that something was obvious to happen. Of course, it was obvious that this situation would happen given the signals. Obviously, with hindsight, it's easy to say this. Now, what are the consequences of hindsight bias? Overestimating the degree to which you correctly predicted an outcome. Obviously, this relates to past outcomes, but also this may lead to unfair assessment of asset managers. With the benefit of hindsight, knowing what actually happened, it's very easy to say, this asset manager is disastrously bad, terrible. Why didn't they see the signs that the market would keep going up, or that we're at the top of the bubble? Whereas in reality, with the ability to look back, knowing what happened, you can always claim that it was obvious this would happen. But when you're there at the moment in time, it's not necessarily so easy to see where the market is going. And I think the corrective measure here and diagnostic measure suggested by the curriculum is quite interesting. If you are somebody who makes investment decisions, then obviously record your investment decisions. But also write down the rationale behind them, why you think this is a sensible course of action. And obviously do it at the time the decision is made, not afterwards, but do it at the time the decision is made. And obviously that will give you a good basis to go back later and see not just whether the decision was correct, but the rationale behind it was correct. And that will allow you to detect whether you are prone to this hindsight bias, which once again, like all the biases we've mentioned here, is a very natural human thing.